Hi, everyone. Welcome to Crowd Forecast News, episode number 176 for April 2nd, 2018. Today we will be discussing the 236th weekly report, which you should be seeing on your screen right now while I'm talking. If you haven't had a chance to take a look at this yet, you can go to TimingResearch.com and download the full PDF there. My name is David Kosmeter. I'm the creator of TimingResearch.com, and I have Rob Hanna back to moderate today, so I'm going to go ahead and turn it over to him.
Thanks, Dave. Good to be back again today. I got a couple of guests with me today that I'm very familiar with and have gotten to talk to a fair amount with in the past, and Steve Lentz and Dave Landry is an old friend. So why don't, before we get going into the official talk here, I'll let everybody go around and introduce themselves. Again, I'm Rob Hanna. I work at Investaquant.com, and I also run QuantifiableEdges.com. I've been a trader full-time since about 2001, or late 2001, I guess I started doing it, which was a weird time. And then my primary focus is swing trading. I also do some overnight trading, but the swing time frame, normally 3 to 5 days, tends to be my bread and butter trades. And I have a quantitative tilt with everything I do. So I'll look at the market and look at stats and what I think the odds are based on different setups and seasonality and whatever other factors are coming into play that look interesting. So that's kind of my approach to the market. You can find me at those places. Let me allow my other guests to introduce themselves. Steve, why don't I start with you, since your name is at the top of my list in the order I wrote them down.
Okay. All right. Thanks a lot. I'm Steve Lentz with Discover Options here at Option View. I'm going to share my screen real quick and I'll just show you a little bit about our website there. There we go. I think that working. Well, let's.
Looks good. Yeah.
There we go. So Option View has been in business since 1983. About 10 years ago, we spun off Discover Options. It's our educational arm. And, one thing we did also was Option View Research. I ran the CPA program there. We traded S&P options and then did swing trading with the E-minis. Primarily, though, Discover Options is involved in the one-on-one mentoring experience. We have professional traders who mentor our students primarily in premium selling through neutral strategies, butterflies, condors, etc. One thing that sets us apart is that we really look at the market conditions for doing butterflies and condors, rather than saying that you can trade all market conditions and just have a good adjustment approach, with the jujitsu and so forth. We come at it from the standpoint of looking at market conditions that are more probable to have those strategies succeed. So that's something that we dive into, and I'll get into that a bit more today.
All right, sounds good. You mentioned you do swing trading of E-minis. Is that the futures themselves or options on the E-minis?
Yeah, when we were running our CTA program, we would sell SP options on the futures options, and then swing trading with the E-minis. So,
okay.
When the market got real volatile, the swing trading did well. And when the market went into a channel and the swing trading didn't do so well, then the premium selling, the strangles would do very well then. And it would all make for a much smoother equity curve when you combine those two.
Okay, so combination strategy. They're interesting.
Yep.
All right. Good to see you again, Steve. We'll look forward to talking to you as we get into this. Dave of DaveLandry.com, formerly of the old trading market site, way back when I used to read them and be impressed.
I became part of that song. So, well, what happened?
I did.
Yeah, Rob was part of that side too.
Yep.
At least for a brief stint.
Yeah,
thank you, Rob. Rob and I do go way back. I believe when it comes to markets, you can only predict the short term. Unfortunately, you just don't make enough money short term trading.
And that's why I take more of a hybrid approach through the money management, where I get in for a swing trade, but I'm willing to stick around longer term for a longer term trade. And I also believe in keeping things very simple. I've gone through the Holy Grail hunt. If you are a trader, been trading a while, you probably have gone through a similar journey where you plot all these oscillators and everything else. And I truly believe that the true enlightenment comes when you start peeling those away and you get back to the blank chart and ask yourself, is it going up, down, or sideways? And other than the occasional moving average, which I'll show you a couple little tips and tricks that I like to use with those, I really don't use any indicators. And I always start with a blank chart before adding moving average. I don't know if you can see my screen. Let me just do a quick screen share. If you go to my website, and I've forgotten I put this up here. It's been so long since I've been on the show, but DaveLandry.com/CFN for Crowd Forecast News. And if you put your email in here, I'll give you a $100 gift certificate, and you can get all 3 of my books for that at my store. It's reusable, in other words. So you can just put in the code, get the book, and then you can get the other 2 books. Anyway, that's pretty much it for me. Rob, back to you.
All right, Dave, you mentioned you do swing trading with the willingness to hold on longer. So you're basically looking for taking the small risks and looking for big reward, hopefully. Is that the...
Yeah, exactly. I'm looking to risk 2% per trade, and I'm looking to get a 1-for-1 out. So let's say if I'm risking $5 on the trade, meaning 5 points on the trade, I will exit half when I'm up 5 points, and I'll get my stop up to break even. And then the secret sauce in all this is allowing that stop to gradually open up on the remaining shares to make that transition to longer term trader. Without going into a lot of details, if you were a purely longer term trader, you'd only be right at best about 28% of the time. And I used to do a lot of mechanical testing way back in the day. I have a degree in computer science, so I figured I might as well use it. But back then, that's about the number that came up. So you could be wrong a lot. And the drawdowns are just abysmal. It's a very hard way to trade. So what I do is I take a hybrid approach where I'm taking that short-term profit and getting a quote-unquote free position, so to speak, where the worst thing, barring overnight gaps, that could happen once I get my initial profit target out is that I break even on the remainder. And then I still have that potential. But if I don't get stopped out, I still have the potential to possibly have that turn into a much bigger trade. And 1 or 2 big trades a year will actually make your year when you're trading like that.
All right. Yeah, it sounds like a real sound approach, Dave. Okay, so let's get into it. We're going to be talking about what the market's going to be doing this week, and so far we're down quite a bit. So if you're going to pick the bearish side, you're cheating. But let me just go through. Let's put it all out there as far rather than explain everything that we're looking at. Let's just say whether we're bullish or bearish, and then I'll let you guys go ahead and talk more. But I've come into the week with a bullish bias. Dave, where are you? Bullish or bearish right now for the?
I'm gonna be bearish as a trend follower.
Cheater. Steve.
Well, I came into this bearish, but only with about a 55% certainty, and I'll show you that later. Moving forward after today, things look much different, and I'll get into that as well.
All right. Well, at least I hate it when everybody agrees, but I'm not used to everybody ganging up on me. So we'll have some fun here. Steve, you want to go ahead and go first and talk about some of the reasons that you're bearish? You said you had a low confidence level, about 55%. So what's getting you to lean that direction right now?
Yeah, let me show you this. This is let's just a second here. There we go. All right, so I'm showing you a picture of Thursday's market condition. And so one thing I like to do, and I do a report every week on YouTube where we look at past occurrences of the current market condition, and then we compare it to what the market baseline is. And so here you're seeing just at the top part of the screen, the market condition as of Thursday. And then I'm going to show you today's, assuming today's bar closes out near where it's at. So you have to define the market condition a certain way so you can go back in the past, make observances, and see what the market did back then. So what I do is I look at price action, trend, And then I look at stochastics and maybe throw in the average true range for the day, depending. But here you see that Thursday, at the end of Thursday, you had a downswing bar on Wednesday and then an upswing bar. We're beneath the 50-day simple moving average. And then in terms of stochastics, we're way down there between 0 and 30, and it's barely trending downward underneath its %D. All that makes for a market condition that's occurred about 52 times since January of 2000. Okay. So down below, then you see the 5, 10, and 15-day average % rate of change, and then the standard deviation. And so at the top bar down there, you can see since January of 2000, obviously we've had a bullish market. And so the average 5-day change from close to close 5 days later, you can see over that time period is 1/10 of a %, 0.10. If you look at a 10-day change, the average 10-day change is 0.19% of a percent, almost 1/5 of a %. And then going out to a 15-day rate of change, close to close 3 weeks later, is at 0.29, almost, basically 0.3 of a %.
And that's just looking at all days, correct?
That's looking at all days, 4,573 occurrences, going back to January of 2000. You can see that on the far right. Okay. And then there's a standard deviation for the 5, 10, and 15-day. And as options traders, we want to note what the standard deviations are, because that's a measure of volatility, and that's important for us. Now, let's see. Should I hide it? Can you guys see the bottom line, or do I need to hide what I see here?
I can't see that very well.
Okay, so I'm going to need to hide this. And
yeah, that's good.
There we go. And so you can see then of the 52 occurrences of this same market condition that's occurred in the past, the 5-day change has been on average 0, which is less than the average of 0.1. And so it's not as good. It's on the bearish side, or at least on the average, it's unchanged. But the 10-day change is at a 0.05 of a % bearish, underneath. And then the 3-week % change is on average 0.37, over 1/3 of a % to the downside. That's on average. And of course, you have the standard deviations that are much higher than the baseline.
Yep.
So that's why I said bearish with just because it's so volatile. We've had a lot of volatility given, when this market condition has occurred, that's at the end of Thursday, you have a lot more volatility, and it barely kind of leans itself bearish. Now, I want to show you then, let's assume that today's bar closes out where it's at. And if you redefine the market condition just like this, and I'm putting in the average true range in terms of a %, it's over 1% today, which, it's going to be a lot more than that. It's over 2%, but I wanted to get some kind of population in the past to look at.
Is that a 1-day range, or?
That's a 1-day range, correct.
Okay.
1-day true range, exactly. And so now you have an upswing bar and then a downswing bar occurring below the 50-day average, with the stochastics trending down in the oversold area, and the average true range is over 1%. That's occurred 29 times in the past. And look down below, you could see that the average 5-day change from, let's say it closes here today, the average 5-day change is at 0.88 of a %. And then it goes down on the 10-day, and then the 15, it comes back a little bit. And of course, the standard deviations are all much greater than the benchmark. So after today, you're looking at an oversold situation where historically, on average, you see some pretty strong bullish activity. Certainly no guarantee given the higher degree of standard deviations there, but all in all, it's looking better after today's close.
Right. So maybe we get a little bit of a washout today if we close below the 200. And are we below the previous lows yet?
No.
No? Okay. We're getting there. If you guys talk it down a little bit during the... Everybody jumps on your bearish prognostications. Maybe we'll get it there by the end of the show.
All right. So that's it for me. I need to somehow stop sharing my screen, don't I? How do I do that? Let's come over here. Stop sharing. There we go. Perfect.
Okay.
Okay. Thank you.
Sorry, I couldn't instruct you on that. I'm pretty bad at sharing my screen most of the time. Dave's the techie. He's got the computer science degree, right? So you can. I'll let you go next, Dave, and give us a little bit of what you're seeing as to why we might be heading lower over the next few days, or at least from the question was from Friday's. Oh no, I'm sorry, from today's open to Friday's close.
Right. Well, that degree, I got that degree back when the Earth was still cooling, so I'm not sure that's going to help me out a whole lot. You were mentioning the recent low in here. You can see there's a February low. We're not quite there yet. As I said earlier, I do like to keep it simple, but I will occasionally use a moving average or two, and I have some shorter term moving averages I also like to use. I put the 200 in the chart. I think the 200-day moving average matters when it matters, and right now is one of those times. From a psychological standpoint, I think it matters that we are now below it, and it depends on whether or not we stay below it or not. Let me show you a very simple concept. Again, I like to keep it simple. I wrote about this before. I wrote about this back in 1995. I'm dating myself, and it was a concept called daylight, and one of my clients has renamed it to Dave Light. So I like that name. We'll stick to that name. And daylight just means you can see the light in between the moving average and the price bar. And you can see here the lows are greater than the moving average. And it amazes me that the longer you're at this, when you start peeling away all those indicators, you can sometimes find something really simple that works. Sometimes I'll be in presentations and somebody will have 100 different buy and sell signals. And invariably, there's like a moving average plotted. And I'm like, well, what if you just bought when you had daylight and sold when you didn't, or shorted when you didn't? And it would probably work just as good. Now, there's nothing magical about this. The one thing you have to realize is everything works better with trends. So if a market's trending, any system, provided it's a trend following system, will do fairly well. Now, just real quick, I could see why Rob, before he gives his spiel, is probably a little bullish just because we're so oversold in here and due to bounce. But as a trend follower, I just follow along with the market direction. I do want to show you something really quick. Longer term, and that's what people often ask about, much longer term. If you take the concept of daylight, Metastock has programmed these indicators for me, and it'll be out in their next version. And you can see you have these bull markets and bear markets when you have a lot of upside daylight and when you have downside daylight, okay? And if you look in this recent run we've been in, this is a weekly chart, you can see we've had upside daylight for a long, long time, and we still haven't tagged that 200-day moving average. I'm sorry, this is a 50-week moving average, okay? 50-week moving average, and this is
Dave,
the weekly chart. Yeah, go ahead.
On the top there, is that just measuring the length of time that you've been above or below the moving average, not necessarily how much daylight there is at that point?
Right. It's not measuring magnitude. So if you have, let's say back here, you can see it was rising, and then all of a sudden you had some downside daylight, so it resets back to zero. Now, somebody said, well, what if you made a cumulative indicator? That might work, but then again, I think it begins to start complicating things once again. Now, there are some interesting things that happen when you get up to about 100 or so in here, 100 days above that moving average. It does tend to correct. Now, this is not my type of reversion to the mean type of trading, but I certainly recognize that this can happen and this occurs. So the weekly is still kind of barely hanging in there. We're correcting down to it. And then on a daily basis, as I just said, we're trading below the 200-day moving average. One thing that's kind of interesting is sometimes a lot of technicals come together, and that's why I would caution you not to use too many, because a lot of times you end up looking at the same thing. But the 200-day moving average isn't that far above the February low. So I would keep an eye on the February low for sure. Mm-hmm. I would wait to see if we bounce from this oversold condition. Now, you have to realize we'll look at the portfolio in a few minutes. But as a short to longer term trader, I'm going in with that shorter term stop, and we've gotten stopped out of all the longs, and now we have a couple of shorts on. So we're letting the ebb and flow control our portfolio. We're not trying to prognosticate and figure out every zig and zag of the market. But as long as we're making new lows, I'm going to stay bearish. And one more point. If you go back and look at the shows before, my personal life got a little crazy in here lately, but if you go back in longer term, look at some of these crowd forecast news shows, you'll see anytime the market was close to new highs within a, let's say 5% or so, or to even 10% of new highs, I was bullish, and I believe that a lot of times you just err on the side of a longer term trend and you do just fine, as opposed, again, to catching every zig and zag. So if you ever go in and look at some of these older shows, you'll say, wow, this guy is always bullish. And if we start or continue to bang out some new lows in here, you'll probably think this guy is always bearish, because I'm just a trend follower following along.
See, the first time I ever saw Dave speak was a long time ago. He knows the story I'm going to tell. And he walked up to the podium, and everybody else was dressed up for this conference, and Dave had a suit coat on and a T-shirt that said "Trend Following Moron."
Somebody had just given me that. Well, what happened was, I can't say his name, but there's a famous guy out there, famous trader, and he was bullish and I was bullish, but I turned bearish because the market kept going higher. And I'm sorry, he turned bearish, and he got mad at me. He called me a trend following moron. He did it anonymously, but I knew it was him. And then at first I was really offended. And then before long, I started calling myself that. And a client sent me a bunch of trend following moron shirts, and we had buttons made and everything. So, but it's silly as it is, that has kept me from trying to outsmart the markets whenever I want to outsmart the market. So it's just keep it simple and follow along.
Yeah, don't fight the trend, right?
That's right.
All right, so I'll give my little view right now, and you basically said it. Part of the reason that I'm looking to the long side right now is the fact that we're pretty oversold, and I've been looking for a bounce. Now we got a little bit of that. We started to on Thursday, but it's not quite there. And so I look at our numbers. I'm gonna try and share my screen if I can. All right. Can people see it?
Yeah.
Okay. Let me go to. So first, I'll show this. This is our swing edges over at InvestiQuant, and we look at odds going out 1, 3, and 5 days based on a few different systems. And we have acceleration systems, momentum systems, and seasonality systems. And what I've noted in last night's Navigator letter was the fact that all of them are actually pointing higher. We're showing win rates on average of 62% and profit factors of about 1.6 there, or 1.66 it says. So what that means is, generally, if you've gotten in at this time and held for X number of days, 3 or 5 days, you would have experienced about 60% more in gains than you would have had in losses. If we look at the 5-day specifically, and we're talking about ES and SPY, they're the S&P 500 type ETFs. Their numbers both look quite strong, north of 60%. We're seeing a 5-day profit factor of 1.6 there and 1.4 there, so they're in agreement, and they're normally off, a little bit, but they tend to confirm each other, which is, and when they don't, that's a red flag. When they do, it's good confirmation. So that's where I'm seeing some bullishness from a seasonality standpoint. It's not just these seasonal systems, but I had a study I showed in the Quantifiable Edges letter this past week that looks at what happens in the beginning of April each year. And it's been pretty bullish since the mid-90s. As you can see, over the first 1 to 5 days, you've had about a 70% chance that you're going to be higher. And obviously, it's not playing out today. I also looked at the profit curve. This is a 4-day profit curve. It has kind of flattened out in recent years, so that was a little bit of a red flag. But overall, it hadn't turned over. It may this week, in which case, I won't give as much credence to this study. But trend is your friend. So when I find studies like this, I do tend to stick with them as long as they persist. So I found that to be something interesting, that we normally get some good moves up in early April. Like Dave, yeah.
Right. Oh, I didn't mean to cut you off. I thought you were stopped. A while back, well, I kind of, just to set this up, I have a friend that's a mechanical trader, and I think he's a lot more discretionary than he claims to be as mechanical. And then I'm hold myself out as a discretionary trader, and he tends to think I'm a lot more mechanical than I am discretionary, or at least that I admit to. And I know you do a lot of statistical research and a lot of mechanical things. But a while back, I'd asked you about one of your systems, and you had said that, well, you weren't taking the short side setups because you had either a trend filter. I don't know if that was discretionary or not, but I guess the question is, since we haven't talked in forever, do you still have a trend filter that you're using on this analysis?
Yeah, well, I generally, what I'll do is I'll establish a longer term bias, and then I'll determine whether I'm going to take the trades or how aggressive I'll be based on that longer term bias. So my long term bias right now is neutral, which means I'll be not terribly aggressive on the long or short side, but I will take trades in both directions. A setup like this, a little study that I show, this is not something that is a trade trigger for me. This is something that helps me establish a short-term bias. So if I have a fair amount of evidence all pointing in one direction, then I'll be looking for trades in that direction. But I don't look at a study like this and say, all right, I'm going to buy it and hold it for 4 days. I got a study like this and say, all right, over the next 4 days, from a seasonal standpoint, I got a wind at my back. I'll be looking for long opportunities. So that's kind of my approach to it. So yeah, I'm discretionary, but I
you back with a lot of statistics.
I establish.
You have a reason for what you're doing. Yeah. Okay.
Yeah,
cool.
And I'll look and I'll have a reason to stay in or get out as well each time. So every night I'll go in and say, yeah, where's the edge? Is it long side or short side? And if it's opposite where I am, then I'll get out. And if it's where I am, then I'll stay in, kind of thing. And if I don't see a strong edge, then I'm normally not in the market. So I'll tend.
And most of your markets are mostly ETFs.
ETFs and large cap stocks. So
Gotcha.
I'll trade S&P 100 stocks.
Okay.
But I don't get into small cap stuff or penny stocks or anything like that.
Yeah, so you're eliminated a lot of the volatility risk by doing that, I would imagine.
Yeah, and I'll buy a lot of pullbacks. If stocks are an uptrend and they pull back, I normally like to buy those, and I find that institutional ownership can help greatly. And when you get these large cap stocks, you got a lot of institutional owners. If you got something that's got one or two institutional owners and they're trying to get out, well, the thing could just continue to drop and drop and drop and drop and drop.
Gotcha.
There's no support there. But you get a bunch of big guys that own the thing, then it tends to move up and down a little more as it makes its way lower. So even if I'm early, or even if I'm on the wrong side, it doesn't tend to completely collapse all at once.
Yeah, gotcha.
So, let's just go through one more time, and let me see, you guys can let me know if there's anything in particular you're looking at this week as far as fundamentals or technicals or news coming out that would confirm your positions or I'm sorry, confirm your bias, or on the other side, make you change your mind. Steve, why don't we start with you? You haven't gotten to talk in a little while. Is there anything you're looking for in particular this upcoming week?
Not really. I just follow price exclusively. One thing, we also look at the VIX, the 9-day VIX and the 30-day VIX. And right now, the 9-day is higher than the 30-day. And so, when we see that coming back, that would give us a great deal more comfort to have that relationship turn more bullish. But generally, in terms of news and all that, I'm just a pure price watcher. I think it's a great equalizer. But with today's huge down bar, boy, if when today's high gets exceeded in the subsequent days, that'll be a big trigger, I would think. Like what I just showed you, it's the oversold signals are definitely playing into that. But I'm intrigued by the 200-day moving average, that we're right on that right now, and we're underneath it. But today's bar is smack right on the thing. And I remember Dave's daylight concept from years ago. I've did some work with that. I think it's wonderful. That was a great concept you came out. I still remember the stocks and commodities article you wrote there.
Thank you,
Steve. That was awesome.
Steve, you mentioned the 9-day VIX and some other day. Was that a moving average on the VIX, or was that something else?
No, because you can look at the VIX, and then there's the short term, the STV, the short term VIX. It's a whole nother symbol that the SIBO publishes a 9-day versus the 30-day VIX. So when you look at the relationship between the two and how they can go apart and come together, you can kind of, have some fun using the relationship between those two as an interesting understanding of what the bias is amongst the options traders.
Oh, that's cool. So you can see whether the panic is in the short term or longer term.
Right.
That's cool.
Yeah, I look at that with the futures as well. I think it's been in backwardation pretty much since we got that explosion in early February, and it hasn't come back into the normal contango where you'd get the shorter term lower than the longer terms.
It did briefly at the end of February and then the beginning of March, but yeah, it's been underwater now, I'm going to say since mid-March for sure, by quite a bit also. Yeah, and
last year it was strong contango for a while. So, I mean, for a real extended period, because everything was so quiet and no one was worried about anything in the short term, right?
Yes. I mean, I think clearly end of January, early February, it went crazy. Yeah, but the first few weeks of February, it was pretty nuts, and then it came roaring back, of course.
Yeah. Dave, you were talking about the 200.
Yeah.
And the February lows. Obviously, those are key support or potential support areas. We've tested 200, I guess, 3 times in the last month and a half, and now there's a chance we'll finally close below it. Is there anything else you're looking at this week, or do you want to expand upon your thoughts there a little bit more?
Yeah, let me do that, because I don't follow the news at all, so we'll leave that out of the equation. And one thing that, now I said earlier, I don't use indicators other than the occasional moving average, and I do have a pattern called bow ties, and all you're looking for there is these 3 moving averages come together and spread out. And I have free reports on my website if somebody watching wants to go pick up a free report on this. But this is a 10-day simple, a 20-day exponential, and a 30-day exponential, and it looks like a bow tie, kind of on its side, but it looks like a bow tie when they come together within 3 or 4 days. Now, this works in all time frames. So if you're, I don't know if it'll let me go back that far on this particular chart without moving up another chart. But if you go back and look at, let's say an hourly chart on the S&P 500, this whole mess that we ended up in there it is right there. It started with an hourly bow tie. And when you get an hourly off of all-time highs, you really need to pay attention. So I'm just kind of throwing that out. That's already happened, obviously. The other thing I want to mention, I put out an article recently for a Proactive magazine, which I think you write for every now and then, Rob. Is that Proactive Trader? Yeah. Advisor magazine. Yeah. And one of the questions that the editor asked me, because I showed this is the first thrust signal in here, and one of the questions he asked me is that a whipsaw signal? It's like, well, you might have gotten a little bit of juice out of this trade and stopped out of the scratch, but anytime you get one of these topping patterns. I have two patterns. One's a first thrust and one's a bow tie. And there's a couple of other ones that are a little bit more involved, but those are the two main ones to watch for. And once you get that pattern, whatever top is in place, whatever high is in place, that high remains in place until proven wrong. Now, like a lot of the work Rob does, that doesn't mean that you want to be short the whole time or shorting the whole time. You still use money management. You might get stopped out. But as long as that high is not exceeded, then that top remains in place. So let's take a look at the NASDAQ real quick. And you'll see, if it'll come up, that we didn't actually have a bow tie back here. If you squint your eyes, it never did cross completely over. But now we have a bow tie coming off of all-time highs. So you will get some of these bow ties sometimes when you're in a range like back here or back here. Those aren't as important as when they're coming off of all-time highs. So we've got this one. Yeah, go ahead.
Dave, can you repeat the moving averages again for people?
I like a 10 days. I like a 10-day simple, and then a 20-day exponential and a 30-day exponential. And the relationship between those, and a lot of other people use different ones that they've become used to using, but I just find that simple. It gives me a true representation of price, and then the exponential moving averages, as you know, catch up the price a little quicker. And one thing we learned from our fellow peer over at the American Association of Professional Technical Analysts is that when a price bar or the close crosses below the exponential moving average, it will turn down. So these moving averages will turn down pretty quickly once the market begins trading below them and catch up with price. So if you're looking at like the NASDAQ would be in a sell signal. You have your crossover here, and then your first up bar was Thursday. So today would be an actual sell on that particular system. So, or price, whatever you want to call it, methodology. So your old highs, until those old highs get taken out, a top remains in place in the NASDAQ composite. And then just one more other thing real quick. If people watch and want to go in and do a little research, go in and look at bonds or gold or any other market that has made major tops over the past 10 years or so, or even 20 or 30 years. And you'll see that they'll all have like something like a bow tie, either on a daily or a weekly. And as long as that high is not taken out, that top remains in place. And the other thing I want to throw out, go back and look at the euro. I think it was like 10 years ago, euro versus dollar. It made what I call a second mouse signal, meaning that the early bird gets a worm, but the second mouse gets a cheese, and you'll have like a bow tie, and you might make a little bit of money on a trade on that and get stopped out. And it'll go on to make a marginal new high and then come right back in. So even though we didn't bow tie in the NASDAQ, it sort of has that look to it. And then if you're into classical technical analysis, you would say, well, Dave, that's a double top. And it is. So you've got this bow tie setting up within this double top. Now, just real quickly, if you take a look at like a weekly, you can see we're just beginning to turn down. Why? Well, because the close is below those moving averages. When you get a weekly sell signal, those can be very powerful. And if you go way back in time, you'd have a weekly here, obviously at 2000. You had a weekly buy in 2003. You had a weekly sell 2007. And then, of course, you had the buy way back here in 2009. So that can help you keep you on the right side of the market. And those tops and bottoms remain in place until and unless that old high gets taken out.
Yeah, I've followed that method for a long time, Dave. That you've had that. You had that in your first book, I think, right? And it's continued to work for years. So it's if people aren't familiar with it, I'd recommend they check it out. It's just simple, staying on the side of the trend, and it's a good way to get you there, right?
Yeah, absolutely. And then it's like, a lot of times you're like, well, that's in hindsight. It's like, well, if you, not to pimp the weekly webinar, but come to the weekly webinar and I'll tell you where we are. And just like this webinar today, it's like, okay, here's where we are. We have the signal that triggered today on a daily. Doesn't mean the market's going straight down, but it means you better pay attention. And it better be one charming long, if you find a long side setup, to step in front of this market that's headed lower.
Yeah. So when I'm looking at my market bias, like I said earlier, if I'm long-term bearish, I'm going to be looking for mostly short signals. If I'm long-term bullish, I'm going to be looking for mostly long signals among the things I trade. Are you similar?
Yeah, the only thing that you made me think about that I want to add to that is net price change. So if we go back to, let's say, December and drag it forward, and maybe we can go back a little bit further back. Let's go all the way back to, let's say, last November. We could do this on the S&P 500 and the NASDAQ. I do it on both. You could see that this market, for all intents and purposes, especially where we are now, hasn't gone anywhere since November. Now, I know we've had some zigs and zags, but if you look at just the net price change, where's the close today? Where's the close going back a week, a month, several months, and so on? So this means that the market is sideways according to this indicator. I'm making little quotes in the air. So maybe have a slight downside bias because of these sell signals are beginning to kick in, and because we're starting to take out the 200. And then, of course, if you look at just the net price change shorter term, obviously, we are beginning to head lower. But because we've got this longer term sideways thing happening, I'm just going to be very, very, very selective. Now, I'm not a huge fan of the short side, but I will short because it's the only way to make money in the down market. And the other reason that I think you should learn how to short, just be careful in doing it, but the other reason is that it helps you to see both sides of the market. You and I have a lot of friends, Rob, that run a lot of money, and I find that the ones that are long only oriented, they always tend to be a little bit more glass half full than kind of seeing it as half empty when the market begins to tank a little bit. And you can't blame them because they can't run around being pessimists all the time. But I like the fact that it just helps you to see both sides of the market.
Yeah, that's something I hadn't thought of in the past, but yeah, I mean, I've always looked for longs and shorts, never had a strong bias for either side. I do find it, it's easier to make money in a bull market than a bear market.
Absolutely.
And it's easier to make money on the long side than the short side. But like you say, it's you're better off looking at both sides to really understand when you got a good edge on the long side. I guess I'll add just a couple quick things here. The 200-day moving average is something that I use actually a fair amount. So for me, if we do get below this and stay below it for a little while, that will change a fair amount of my studies. I use it as a filter, just a long-term trend filter, and I use other long-term trend filters as well. But really, it's as good as anything I've found. I'll look at things like the Golden Cross or Death Cross. The 50 and the 200-day moving average there. What side are you on that? I'll look at combinations of longer term moving averages. So you can look at a 50, 100, a 150, a 200. Take a sampling of long term moving averages and just see how many are you above or below, right? And if you're above the majority of them, if you're above all of them, then you're in an uptrend. If you're below all of them, then you can feel pretty confident you're in a downtrend. And if you're mixed among them, then you're probably in neither strongly. And that's another way I look at things sometimes. And then, Steve, you mentioned the VIX. I have found looking at where you are in relation to that to be useful as well. So you could take like a 200-day moving average of the VIX or a 50-day moving average of the VIX and say, are we above or below that? The thing with the VIX is that it'll be more reactive, right? So you'll zoom through the 200 a lot quicker on the VIX than you will on the S&P. Because you get more emotional. But it kind of lets you know, all right, what kind of market are we in? Well, we're in an emotional market, even though we're maybe above the 200-day, still on the S&P. We're also above it on the VIX. So that's you could almost make quadrants there, above or below to the 200 of the S&P, above or below the 200 of the VIX, and find out where you are with things. Yeah. The other thing I'm looking at from a longer term standpoint is.
Hey, Rob, I want to say something real quick before you go on to the next thing. I found it interesting that you said something as simple as 280 moving average is a trend filter. Years ago, and I probably need to watch what I say, but years ago, I did some contracting where I get paid to program systems. And if a system didn't work, they told me, well, throw a 280 moving average in. And then usually I can make it work by putting some kind of filter like that in. It's like, doesn't work on the short side. Well, throw a 280 moving average in, and then the system would get published. Anyway, I'm going to dig myself a hole. But I found it interesting that you pointed out the 200 as a trend filter, because it can be. It's interesting. Anyway.
Yeah.
Go ahead. I didn't interrupt you.
That's all right. Yeah, I found it as far as simple looks at are you in an uptrend or a downtrend, it does a pretty good job. So I don't think there's anything magical about it, but if you're like your daylight says, you're south of it for a while, you're probably in a downtrend. You're north of it for a while, you're probably in an uptrend. The other thing I was going to mention is the Fed recently. So we've got we've had the Fed that has been expanding the balance sheet for years now with the QEs, and now they've been bringing it back in. We've got they're raising interest rates, and they're also lowering their SOMA account, which SOMA is an acronym for System Open Market Account, and that's where they hold all the bond purchases that they have, and they've been lowering the balance of that. Fourth quarter last year, it was by $10 billion a month. First quarter this year is they upped it to $20 billion. Now it's going up to $30 billion a month. Generally, you look back at a chart of the SOMA, and I show this on my website, but you can see if that's moving higher, so is the market. And when that's moving lower, so is the market. It's just an easy way of saying don't fight the Fed. And right now, if you're fighting the Fed, you're on the long side, unfortunately. So that's a concern of mine. As long as the Fed has this aggressive stance, that the bulls are going to have the wind in their face from a liquidity standpoint. We could see these liquidity events where you get sharp spikes and things like we've seen in the last couple of months.
Hey, Rob, you gave a speech. I'm sound like I'm kissing up, but Rob gave we go back and forth. Believe me. Rob gave a speech a few years back, which I thought was fascinating, and he said that that the Fed was throwing money at the market, which everybody knew, but it was sort of like a drug where it took more and more and more and more money to keep the market going. And so, where are we now in that cycle? They taken away the punch bowl. Is that what you're suggesting, or how does that speech? Can you update that briefly to where we are now?
Yeah, they basically took it away starting in October, and they've been trying to wean us off the drug, right? So it's like you get a little bit, but they're pulling you off it harder and harder. And they're supposed to up they're going to accelerate the reduction in the SOMA account again in the summer. Once we hit the end of this quarter, it's going to go from 30 billion to 40 billion a month, and then again in October from 40 billion to 50 billion, and it's supposed to stay there, until they change their policy again. But we'll see if it actually gets that far, or if at some point here there's some type of bad enough correction that the Fed says, all right, we're going to step in and help this thing out again, and the plunge protection team comes back into focus, and they start pumping money in again and helping out the market and helping out the economy. But right now, yeah, the market's going through Fed withdrawal. So we're yapping pretty long here, I guess. And we got to get to the final question, which is a money management question. So it's question number 4 here. When you enter a trade, how do you decide on your position size for that trade? Dollar amount, percent of account, confidence in signal, etc. Steve, you want to tackle this one first?
I'll tackle that one. And I was looking at some of the answers that were given, and I didn't see the one that I would focus in on, which is risk. To me, you want to calculate how much risk you're willing to take and then back into the number of contracts or share amount relative to what your risk would be. And the risk should be based upon, in my opinion, should be based on a percentage of your account. And so, and again, but it depends on the approach you're trading. As a option premium seller, you're going to have to know just from history of that approach and maybe doing some back testing how much you could lose on a given campaign. What's the word? And that's one thing we do quite a bit of is going back in time and shock testing our approaches. We'll, just take the worst times and try and pick the worst entry you could have and ask yourself what, and walk through the approach using historical data. How much would we lose on this campaign? 9/11. You could take it through even the flash crash in May of 2010, I think it was, early May. What would happen had you started your approach or even had it at the worst time? And then you have that amount as your baseline in terms of what you could lose. And now you want to back into it in terms of risking no more than, say, 1, 2, maybe upwards of 5% of your account tops. I think Schwager in his books on all the trading wizards, when you read all those interviews, it seemed that the maximum amount that the human psyche could handle was losing 5% of your account before you go on tilt and really bad things can happen. And I know, and talking to so many of the folks we have, and then for my own trading, we can all go to that one trade where, we got the revelation that this was definite truth, that you had to focus on how much you were risking on any one position. And if you couldn't sleep, well, you were trading too big, right? And for some people, it's 2% of your account. For others, it's just 1%. It's even less. I think Yan wrote in his books, he would go to 10%. I read in one of his books. He said, divide your account into 10 parts and risk. He was trading huge at points. But so it's all for me. And
he also died broke too, by the way, Steve. So, allegedly, if you do some Googling on that. So you mentioned the Black Swan. I bought this card the other day. My wife's like, "Why are you buying that?" I'm like, it's something to do with the markets. I keep this on my desk and I look at it often and keep me to remind me of that. Black Swan is an event you think won't happen, but it will.
Great picture.
Thank you.
Yeah, Black Swans happen a lot more often than they're supposed to.
I actually had, all kidding aside, the thing is, it was Nicholas Taleb, and his whole point is just because you've never seen a black swan doesn't mean that they don't exist. And I had a black swan laying in my pond, and I've still been looking. Nobody believes me, but I'm still looking for the picture of it. But it was a bit of an omen because we had some issues shortly thereafter. So if one ever lands in the pond again, I'm going to go to cash.
Dave, you want to tackle a question? How you get?
Sure.
How you
Steve, I didn't want to interrupt you, but you gave you mentioned a lot of good points, which I'm going to kind of rehash on now. First of all, when I just put in a test symbol, just a symbol. This is a real trade, but this is the actual open portfolio, and the numbers will look a little bit better today with today's slide. These are 2 shorts. And what I do is I determine how much I'm going to risk on that trade. Now, there's a popular methodology out there that says we should all risk 8% of the stock's price. Well, that's like saying we should all wear a medium-sized shirt, something my fat ass hasn't done since I was maybe 5 years old. So it's almost 50 years since I've done that. But anyway, some of my stocks that you'll see in here, I might have maybe a 20% stop, maybe even more if I'm trading a volatile biotech or whatever. But what happens is, as that stop grows, and I'll just punch in a number. If anybody wants a spreadsheet, I'll be happy to give it to you. You'll see that, let's say we double the risks by going to a 2-point stop. Well, those share size comes down by 1/2. And this is based on a hypothetical 100K account risking 2% per trade. So on each trade, you're going to risk $2,000. And you'll notice, well, actually, I don't have any winners. The last one came out. But what happens is we're looking for half of the trade. This is one trade. So in this case, it was 400 and 30 shares, I guess. You divide it by 2. So 215 go on one side and on the short-term side, and 215 go on the long side. So as soon as we get 1% of the portfolio value, in other words, $1,000, we're going to take profits off, and we're going to bump that stop to break even. So what you're trying to do is, as Rob and I were talking earlier, you're trying to get a free position out of it. And worst thing can happen, barring overnight gaps or a black swan landing in your pond, is that you break even on the remainder of the trade. And the best thing can happen is you're in a trade for a long, long time. I'm slotted as a swing trader, but sometimes we'll hold positions 6 or 8 months, and those are obviously the really big winners, and that's what really makes your year. So account value divided by, or times 2%, I should say, $2,000 per trade. And let's say you're risking $2. Well, 2,000 divided by 2, you would buy 1,000 shares of the stock. And so what's happening is we trade these volatile stocks, but we reduce the amount of shares based on that volatility. And a lot of people are scared of volatility. It's like, well, I can't use a 20% stop. Well, if you're trading fewer shares, then you can. And one argument that I often make, and I've published a lot of articles on this, is that I think you're actually better off with more volatile stocks. My feeling is it's better the devil you know, because something bad could always happen in a less volatile stock. And the example that I use, I did a course recently where I use this example. The CEO decides that he wants to sexually harass the secretary, and then the company loses billions of dollars overnight. And that was in a very stodgy, boring, low volatility. I think you're better off in a biotech trading fewer shares than in something a little bit more brick and mortar, so to speak. Now, if you're looking at the portfolio, you might think, hey, Dave, those look like some brick and mortar stocks. In fact, there's a home builder in your portfolio. Well, the short side's a little bit different. On the short side, I actually like those more efficient type of stocks because the bigger they are, the harder they fall. And as Rob mentioned earlier, if you have, I don't know if this is pre-show or not, but let's say you've got 1,000 institutions in a stock. Well, when that stock starts going down, eventually they're all going to have to unload. Maybe initially they'll trade back and forth between themselves, but eventually they're going to have to unload, and that stock might be priced for perfection. And that's the closest thing I will say that I actually use the fundamental. I don't actually use the fundamentals, but a company that's actually established and making money might actually be a better short when the market turns like it is now than trying to go after like a hot biotech or something, which could have like some big announcement tomorrow, the next day, which wipes out your position and then some. So hopefully that made sense. If anybody wants a spreadsheet, shoot me an email and I'll make you a copy of this sheet for you.
Thanks, Dave. It looks like a nice, simple way to manage the risk there. I don't have a whole lot to add as far as the managing position sizes and trades. I look at a percentage of my account. I look at my confidence in the signal. I do a lot of these things. So I'll anticipate how much I'm willing to lose or anticipate I could lose on a particular trade. And then I will position size accordingly. And very similar to how Dave and Steve suggested doing it. So rather than go too long here, why don't I go around the horn and let you guys say if you got a trade idea for the week, or if you have anything. Also, if you have anything special going on at your sites that you want us to know about, then please do so. Dave, I'll let you go first, then I'll go to Steve since I've been going to him first every time. If there's anything you want to tell us about DaveLandry.com right now, and also if you got a trade idea.
Actually, for people that are paying me to tell them what to do right now, I'm telling them not to do anything. So you're getting the same exact advice that I told them. I do publish a daily watch list and say, okay, if you feel like you must trade, this is what you might want to take a look at. I did a webinar last week, and when I was getting ready for the webinar, I thought, why don't we talk about patience? And so I went back and I said, well, I talked about that last year and last summer and last fall. And then I'd completely forgotten that I talked about it the prior week. So patience, very important. I beat the dead horse on that quite a bit. I think if you're just patient, let the market come to you, you'll do just fine. Now is not a market to do a lot of trading. Now's the time to sharpen your axe. If I don't know if you can read the URL here, but it's davelandry.com/CFN for Crowd Forecast News. So if you go here, put your name in, you'll get some stuff which you could go ahead and you'll get some videos on trading. And as I said earlier, you can get all 3 of my books. And then when you're on my website, if you go to store, if you scroll down to the bottom, I'll make you walk through the gift shop first. But there's free stuff on the bottom, and you can get a lot of free reports on all these patterns and setups that I talked about today. But thank you, Rob, for hosting. You've come a long ways. You're a pretty good host there, Rob. So thanks for doing that, man. And thanks for having me here today. I appreciate it.
All right. Great talking to you again, Dave.
You too.
Steve, how about you? What's going on at Option View? If you want to tell us anything there, or if you got a trade idea, I'm sure everyone would appreciate it.
Well, right now, given that how volatile the market is, we're underneath the 50-day average. So the premium selling approaches, butterflies, condors, are kind of in a holding pattern and waiting for the market to get back into a more, back above the 50. And there's some other things we look at as well in our conditions for trading in those approaches. And so those strategies are pretty much on the sideline. In terms of bull put spreads, that's another approach we teach. We're waiting on the sidelines for more of a bullish signal to occur. That's another part that we do and that we teach. One thing we have rolled out here recently is a butterfly course. It's a 3-part course for trading broken wing butterflies in a campaign style. And what we do is we teach when to get into these and how to put them on and how to campaign with them, how to make the adjustments, and then how to do a money management approach. And it's a 3-part mentoring series. And you can go to our website or go to optionview.com, take a look, or you can give us a call. Down there, you could see the 847-816-6610, where we tell you everything you need to have and everything you need to know to trade that approach. And we give you Option View for 3 months as well to have the tools to back test it and practice. So that's kind of what's going on and at Discover Options.
All right, great. Thanks, Steve. Much like you guys, I'm not doing a whole lot right now. I actually I had some long exposure towards the end of last week. I got out of some of it at the close on Thursday. I got out of a lot more of it at the open today, so I'm not doing a whole lot. We'll see what's going to happen with this sell-off, whether I decide to start building up more long exposure or whether I wait for a bounce and start shorting into it. But I don't have right now. It's a little bit of a exercise some patience and sit in your hands. There's a system I use, quantifiable edges, call it my catapult system, and it looks to buy capitulative selling, real strong oversold situations, and I measure the number of S&P 100 stocks that are triggering, and I call that my capitulative breadth indicator, CBI. If you go to the Quantifiable Edges website, you can download a report I did on it about a month ago for free, and it looks back to 1995 and looks at how the market's done when the CBIs hit certain levels. And on Thursday, it went back to 0, and it's not going to move up today at all, it doesn't look like. So while we're getting a strong sell-off, my capitulative breadth indicator isn't saying that this is necessarily the end of it. At InvestaQuant, I'd also encourage you to check out the site there. Actually, the short-term stuff's been doing very well because we've gotten a lot more volatility there. So a lot of times what people will do is they'll shorten their time frame. You can make just as much money in less time if volatility is real high. So if you typically swing trade and you want to look at the day trade and stuff, you can always do that. But we've got the swing edges there, and I showed a screenshot of that. I encourage you to go and check that out. You can get a free trial there as well. And that's it for me. It was great getting to talk to you guys. Dave, thanks for having me again.
Yeah, thanks, guys. Great show. just a reminder for everyone watching, be sure to hit the YouTube subscribe button if you haven't yet to get updates on future shows. Also, you can go to TimingResearch.com to get access to any of the past reports or any of the show archives. Be sure to join us tomorrow, April 3rd, for the 29th episode of Analyze Your Trade. That's at the new 4:30 p.m. Eastern Time time slot. And let's see, Jim Kenny, John Thomas, and Michael Filiguera will be on that one. And just want to thank my guests again for this week. Dave Landry of DaveLandry.com. Great to have you back. It's been a bit. I was looking at my records, and this is your 80th time being on the shows. So good to have you back this week. Also, Steve Lentz of OptionView.com and Rob Hanna of InvestorQuant.com. So thanks, guys.
Thank you.
Thank you, David.
Thanks.